So we continue to talk about how to price the bond. So first of all, we wanted to calculating the issuance price of the bond. So the issuance price of the bond equals the present value of a bond face amount plus the present value of the periodical interest payment. So to calculating this present value, we need to know that the face value of the, first of all, what is the face value of the bond? And second of all, the interest payment each period based on the stated interest rate of the bond. Remember, that's $3,500, basically, using the prior example. And face of the bond in the prior example is 100,000. Okay, and the number of periods until end of the bond mature, and that was the 10-year bond and paying semi-annually. So that will be 20 times, right? And the market rate of interest rate per period, let's say 7% at that time. So remember, this is the market rate, not the stated rate. Okay. Except for the market rate in interest rate, this item can all be found on the bond contract. So this three things can be found on the contract except this one. So in our earlier example for California coasters, the face value is 100,000. The interest payment every 6 months is 3,500, based on the bond stated rate of 7%. The number of periods to maturity is 20 because the bond pay interest semi-annually for 10 years. So bond issue at face value. So there are three ways to determine the issuance price of the bond. We will apply those three methods to bond issuance at their face value. The three methods are listed here. We can use a financial calculator, or we can use Excel, or we can use the present value table factor. This is gonna be the exam one, and we're gonna give you exam using the financial value present value table, because some of you guys don't have the financial calculator and you are not able to use Excel. So if say in the future you are trying to use a financial calculator, so the face value, which is FV key here, if you want to calculate in bond pricing, you will put the future the face value of the bond in there, and then the PMT key, you will put the payment for each period, and you will put the time of the period, and I will put the real the interest rate. If it's 7% of the market rate, and then twice a year, then you 7% dividing 2, and then 3.5. You don't need to put a percentage behind it, okay? And then you press the PV key, and you find actually it's going to be $100,000. And if you're using Excel, similarly, you want to list the face value, interest payment, number of periods, and market interest. At this time, you need to either write 3.5% or 0.035, and then you use the PV as a function in the Excel. You put the market interest rate first, and then number of time period paying, and the payment amount, and then the future value of the principal amount. Or we can say the face value, the future in the future, right, for 100,000. So therefore, you can calculate in the issuance price. So this is the method that we were going to use in the exam, which is I will give you the present value rate, right, of a face value amount. It's a table, and you're going to find the I and N, right? I is rate, like market rate, and is the payment period. And then in a table, it will be a table, and then you have to find the present value, say at 3.5% and 20 period. You will find this number, and then which is 0.05, and multiple that, you find the present value of the face amount is 50,257, and then you were using annuity table, right, of the present. Remember the annuity table, present value of annuity table, you will find out same thing. There's a different table, okay? You will find out the rate at 3.5% and the period of 20 period. You will find that annuity present value of annuity table, this is a 14.21250, and then you have a $3,500 for the installment payment or annuity for 20 period. Then therefore the interest payment of present value is a 49,743. So therefore the issuing price of the bond is $100,000. In other words, if now you are borrowing $50,000 from bank at 7% annually and payment of 5% payment of 7% a year, you basically at the end of the loan, right, you are paying $49,743 of interest. Okay. And the bond issuer discount or premium. The following the slides is showing that if how to calculating at a discount. So for example, if you are paying at a discount, that means that the real market interest rate, remember, was at 8%, hence 8 dividing 2 is 4. Therefore, your present value calculated is 93,205, and then your face value is 100,000. Hence, you are issuing at discount. Similar thing, exactly same formula. Just make sure that your market rate right now is 4%, and your face value is 100,000, and your interest payment is embedded at 7%, right? Hence that immediately the calculator knows that you are issuing at a discount, right? So therefore your issuance price, right, is actually lower than your face value at $93,000. And then if you use the calculation table, which is first of all you need to calculating the present value of the face value. You use the present value table of $1, and then you find out that at a 4% 20 period. Why do I use 4%? Because we want to find the table based on the I and the N. I here is actually semi-annual rate. Okay, so therefore you need to use 8% dividing 2 to look for the I here. Okay, 4%. And here is actually 20 because that's how many period you're paying, right? So that means 4% 20 period later, what is the rate? What is the present value, right, of $100,000? It's only worth $45,639. At the same time, you wanted to calculating the present value of interest payment, which is the installment payment of $3,500 for 20 periods, and then you will use the present value of annuity, right? Annuity of the present value. So you will also find 4% and 20 period, and you will get this number of 13.59. And then therefore you calculating the interest present value of the interest payment is 47,560. Once you're adding these two up, you find out the pricing of the bond is that when you issue a 7% a bond borrowing $100,000, while the interest rate in the market is 8%, you only can get paid $93,205. Okay. So the interest rate we use to calculate the bond issue price are always the market rate, never the stated rate. Some students get confused and incorrectly use the stated rate to calculate the present value. If you use the stated rate to calculate the interest payment for each period, but use the market value to calculate the present value of the cash flow, right? So that's the key. So we use the stated rate to calculating the cash payment, but we use the market rate to conducting present value of the interest payment. Okay, that's the key. So stated rate is used to calculating 3,500, and the market rate is to calculating the interest, the present value of all interest payment. Okay. Okay, so same thing here. If I issue at a premium, hence that you, at the specific case that you borrow 100,000 and you promise to pay 7%, and a similar risk company only paid 6%, hence that you are issued at a premium. So therefore, the interest rate here is a 6 dividing 2 is a 3. Hence, if you use a financial calculator, you find you are issued at a premium, 107,439. And similarly, using Excel, if you're using the table, you also can find the present value of 100,000 at the interest rate of 3% and 20 period, right? And then also present value of annuity table, if 3% at 20 period is 14.8877, you use each period payment, multiple this number, you get $52,071. Hence, you find out you are issued at a premium of $107,439. In other words, if a bond issued at a discount, that means the stated rate is less than market rate. If a bond issued at a face amount, that means the stated rate equals the market rate. If a bond issued at a premium, that means the stated rate is bigger than the market rate. Okay, the issue price of a bond equals the present value of the face value at maturity and plus the present value of the periodic interest payment. The bond can be issued at the face amount, below face amount, and above face amount. So, which of the following statement is true for bond issued at a discount? Is when the stated interest is what? Is smaller than the market rate, right? Right. Okay. So a company retires a $50 million bond issued before maturity when carrying value is only $49 million. Now the market value of this bond is the $54 million, or the company will record, right? So book value or carrying, or we can say carrying value is $48 million now, and then the market value of this bond right now is for $54 million. Hence, that is, we have a $6 million of loss, right? Because in order to retire this bond, the market asks you to pay $54 million, right? And then the book value, the carrying value of this bond is actually $48 million. That means you are using $54 million to retire a debt that only worth $48 million. Hence, that you have a loss of $6 million. That's why, remember earlier we said the earning management can be done to increasing the gain is when the bond price goes down and the book value is actually high. That means you make money, you gain. In other words, you retire the bond at a cheaper price. Saying that on the book you owe someone $10 million, and then this bond right now only worth $8 million, right? Remember? And then hence that you gain $2 million, right? You only pay $8 million to get rid of a debt that was worth $10 million, and in this case you pay $50 million to get rid of a debt or retire a debt that worth $48 million. So therefore you lost $6 million. Okay, so now we wanted to talk about the debt analysis. When you want to use a Coca-Cola and a Pepsi as an example. So first of all, we wanted to assess the impact of long-term debt on the risk and the return. Long-term debt is one of the first places decision makers look when they're trying to get an understanding on the risks. for example, there's a two ratio used to measure financial risk related to long-term debt. For example, debt to equity ratio and time interest earned ratio. And we know that Toys R Us already went bankruptcy, and this is a note to their financial statement that they stated they have a substantial indebtedness that have a significant negative consequences on their operation, right? While almost towards the end they are bankrupt. For example, they said high debt increasing our vulnerability to general economic and industry condition, and high debt reducing our ability to fund our operation and capital expenditures, capitalize on the future business opportunities. High debt increasing our difficulty for us to make a scheduled payment on outstanding debt, and the high debt, deep substantial indebtedness, exposing them to the risk of increased interest expenses, and deep in debt causing them to make non-strategic divestitures, and limiting their ability to obtain any additional financing, limiting their ability to adjust to changing market condition and reacting to competitive pressure. So put them into a competitive disadvantage compared to the competitor. So therefore, debt to equity ratio is actually a very important risk measure, measuring how risky this company is, because debt requires payment on the specific dates. If you fail to repay the debts or the interest associated with the debt on a timely basis, you will result in default or perhaps even bankruptcy for the company. Other things being equal, a higher debt to equity ratio, okay, the higher risk of bankruptcy. When the company assumes more debt, they're more risky. So therefore, debt to equity ratio, of course, is equals to total liability divided stockholder equity. So in other words, the higher the debt to equity ratio, the higher risk of bankruptcy is. When a company assumes more debt, the risk increases. With that being said, I also want to mention something here. Don't always think that high debt is not a good thing. Debt can be also advantages as well, because that it can increase the return to the stockholder. If a company earns a return in excess of the cost of, so if your return rate is higher than the borrowing rate, right? And then shareholders are provided with a total return greater than what could have been earned if it's only equity alone, right? Unfortunately, borrowing is not always favorable because there's a risk involved. So sometimes the cost of borrowing of funds, okay, when this borrowing rate is higher than the rate of return, then you are in trouble, right? That means that you are losing money, and then you are more likely to be default. Hence, there is a risk reward analysis, a trade-off. You first wanted to enjoy the borrowing to give you more capital to earn money. At the same time, you needed to worry whether your rate of return is still gonna be surpassing the borrowing rate. If your rate of return is lower than borrowing rate, you are losing money, right? You have to make sure that you pay the interest. But if you can make sure that your rate of return is still higher than your borrow rate, then that means your equity holders actually make more than they can if there's no stock issued. If you are solely based on stock investment, right? You're solely based on equity financing. So therefore, it's a double-edged sword, right? So only thing that I want you to take away is that how do you calculating debt to equity ratio is using total debt to dividing total equity. Okay, let's look at the Coca-Cola and Pepsi company as an example. So let's calculating the debt to equity ratio. So first of all, the $64,000 is the year 2016 stat of Coca-Cola, and the equity is 87,200. Equity is 23,220. Hence, that the ratio is 2.76. That means the Coca-Cola that to $1 of equity is matched up with $2 of borrowing, right? And then when we look at the Pepsi, so they have a $62,000 of liability. At the same time, they divide in their equity of 11,000. So their debt to equity ratio is a 5.62, much higher than the Coca-Cola. That means for $1 of equity investment, they have a $5 of borrowing matched against, right? So therefore, they are highly levered. Yeah, leverage is not a bad thing. Leverage can be almost an analogy like a lever in a physics. So if you have a similar strength when you use a lever, you can lift up a much heavier object than you only use your bare hand. Same here. Highly levered company, it can make much more money than low levered company. But at the same time, that doesn't guarantee that that's a good strategy, because leverage bring high risks. Yeah. So in other words, the added debt, no matter it could be good, it could be bad, and depending on whether the company can make a return on higher than the borrowing cost, right? If you can make return higher than borrowing cost, that means you have left over for your equity holder, your investors. And so let's look at, so therefore, how do we calculate in return? Do you remember we're calculating return on asset? So the Coca-Cola's return on asset will be the net income dividing average of total asset. The Pepsi return on asset will be net income dividing average asset. The average asset, remember, is the beginning asset plus ending asset dividing 2. So Coca-Cola's rate of return is 7.4 and Pepsi is 8.9. So for both companies, the return on asset is exceeds cost of borrowing, right? For example, the cost of borrowing for each company is at 4%. So therefore, this is good, right? The borrowing rate is less than the return rate. Therefore, both companies should can increase their total return by borrowing at a much lower rate than earning a higher return on those borrowed funds. And then this illustrates the power of leverage to increase the company's profits. Okay, this is especially true for the Pepsi company because its return on asset is higher than Coca-Cola. However, if a return on asset fall below 4%, Pepsi has fall below the rate of charged by borrowed funds, Pepsi's company greater leverage will result in a lower overall return to the shareholder, right? So if you this rate is 3%, then you have to minus the cost of borrowing, so your rate of return become minus 1%. Okay. So another thing that we want to understand is called the times interest earned ratio, meaning how number of times, it's a omission of the 3 words, the number of times the interest earned. It's an indication to the creditors of how many times greater earnings are than interest expenses. Basically, you use net income plus interest expenses plus tax expenses and divide interest expenses. So lenders require interest payment in return to use of their money. Failure to pay interest when it's due will evoke penalties, possibly leading to bankruptcy. A ratio often is to measure this risk is the times interest earned ratio. And this ratio provides an indication to creditor of how many times, right, the earnings are covering the interest expenses, are higher than the interest expenses. Okay, And company's earning, which is a profitability, provide indication of its ability to generating cash from operation in current year and in future years. And it's a cash, it's cash that will be used to pay interest payment. So the higher a company's interest earnings related to interest expenses, right? And this is actually operating earnings. If you remember, we're adding back most important expenses, right? And if the company's earning relative to the interest expense is higher, then it's more likely to pay the current and future investment payment or debt payment, right? Let's look at Coca-Cola and Pepsi again. So the net income plus interest expense plus tax. So net income is this number plus tax expenses plus interest expenses, right? So then that means that we are getting a value of 88,969 dividing the interest expense of 733. We get times interest earned ratio of 12.1. And Pepsi, on the other hand, because remember they have a high leverage, therefore their net income plus the tax expense plus interest expenses is 9,895 dividing the interest expenses. Their times interest earned ratio is less than Coca-Cola. Makes sense because this Pepsi is a higher leverage than Coca-Cola. Okay, so the key point I want to take away from this is that the debt to equity ratio is an important measurement of financial leverage. And taking on more debt or higher leverage can be good and can be bad, depending on whether the company can earn a return in excess of the cost of borrowing funds. The time interest earned ratio measures a company's ability to meet interest payment as they become due. Okay, which of following ratio best measure financial leverage? Debt to equity ratio, right? Okay, so we are at the end of the chapter 9. I wanted to give you a quick review of what's happening. So we are talking about long-term debt. At the beginning, we said we're talking about the capital structure, right? We said there's two ways of financing. One is borrowing, and one is issue equity, right? And we said borrowing is actually cheaper because there's a tax benefit because the interest expenses is subtracted before net income, and therefore you're paying less interest. And then we said there's three kind of long-term debt. We said there's a note payable, there is lease, and there's a bond, right? Notes payable is talk about say car loan or house loan. It's basically installment payment for a fixed period of time, right? And then every time you pay the installment payment, you are paying essentially interest, and you are reducing the principal as well, right? At the end of the period, you paid off the loan. Lease, we said in order to record a lease, we needed to debit the lease asset. The most important thing is to understanding how much lease asset is, and it's very similar to bond pricing, right? And we're using the present value table of annuity, which is the installment payment, and we're calculating the lease asset amount. Bond is relatively a little bit complex thing. We said the bond have a face value and the stated rate, right? And if the market rate is equals the stated rate, we think that the bond is issued at par or at face value. Hence that the interest expense and the payment is always the same, doesn't change. However, if we are issuing if our promised note or if our bond is giving a interest rate that is lower than the market rate, we are issued at a discount, right? And then across the period of life of the bond, the interest expenses is increasing than is always increasing. Okay, and the discount is a discount. The amortization of discount is to increasing the carrying value of the bond. Okay, and if we are issuing a bond at the interest rate that is higher than the market rate, that means we are issuing at a premium. And when we issue a premium, our interest is actually decreasing and our carrying value of the bond is decreasing. And the most takeaway is that the cash payment of each period has to use the stated rate multiple the face value of the bond. And the interest rate is interest expense is always equals the market rate multiple the carrying value of the bond, right? And the difference between them is gonna either increasing the carrying value or decreasing the carrying value, depends on are you issue at a discount or are you issue at a premium. And then we talk about the pricing of the bond, right? And I think that's things that you need to remember is you need to add in the present value of the maturity and present value of payment, interest payment, and then that's gonna price of the bond. And last topic we talk about the debt to equity ratio is a measurement of risks, right? And we wanted to also talk about times of interest payment is calculating how likely the company to meet the interest payment duty, right? So it's not very much, but it's also, if you will not have a financial background, you might have a little bit hard time. But trust me, and we will work together during the class, talk about the using the exercise as examples to illustrating premium versus discount versus at issue at face value. Okay, have so thank you very much, and I'll see you guys next time.